This is Viewpoints by Hennessy, a podcast featuring the latest thinking from the team at Hennessy Funds. My name is Jay Coulter. Joining me for this update is portfolio manager Dave Ellison. Dave manages both the Hennessy Large Cap Financial Fund and the Hennessy Small Cap Financial Fund. Dave, let's jump right in. What do you expect from the financial sector as a whole this quarter?
Well, I think we've had a pretty stable environment for at least a year and a half now, so I don't expect much different. Rates are kind of where they are. The credit situation's about the same. The level of economic growth is about the same, and the banks generally reflect what's happening in the economy in a bigger sense. So I think it's going to be a relatively uneventful quarter, which is usually a good thing for the banks. You want them to be, the not the elephant in the room, but the guy that's actually paying attention and doesn't blow up. So I think that's a good thing. But the industry is fighting, the flatter yield curve. It's fighting the general credit trends in the economy. And I think it's fighting the fact that the economy's been good for a long time. And so the next big event's probably going to be a downturn. And that may come 2 days from now or 20 years from now. And so the banks, I think, should, pay attention to that and start preparing for it, which means, building reserves and building capital for, the next couple of years.
Yeah, and it's hard for us to even have a conversation about the financial sector without getting your opinion on the Fed and their moves going forward. How are you thinking about it as you manage these portfolios today?
Well, I tend to look at, the banks, how are they doing now? What is the current macro environments that's producing those returns? And if you just keep it all the same on a ceteris paribus kind of thing, will they continue to make money and how things will, and can they get better under current conditions? And I think a lot of companies try to say, well, there's going to be rate cuts and there's going to be more loan growth and there's going to be less credit costs and there's going to be less compliance. I say, well, if that doesn't happen, then what, right? You're sort of putting yourself in a situation where if it doesn't happen, that means maybe bad things are going to happen. So I think I generally want to focus on the banks that, can operate in any environment unless it's super extreme to the downside. And we very rarely get those kind of environments. And so the Fed actions one way or the other. Yes, it matters when they raise rates because there's mark to market. But now that we're here, I don't think the Fed actions are going to make that much of a difference this year and maybe even to next year.
All right. So, what are your thoughts on the regional banks today?
Well, I think that, one of the things that I've talked to a lot of people about is that, the industry knows about credit. They know about an inverted curve. I've been doing this 40 years. I've seen, two or three rate cycles, where the curve is inverted. I've seen two or three credit cycles, maybe more. Maybe I missed one along the way. I don't know. But what we're seeing now is a real challenge to the deposit franchise. And you saw that, 18 months or so ago with Silicon Valley and how they had the big deposit run. And the market is now, in my view, has to figure out how that deposit franchise is going to develop. Is it going to hang around and be valuable, or is it going to get priced out of the market where they're just going to lose their ability to price those deposits lower than the market? And so I think that to me is the critical sort of next 5 year thing. The golden goose was always the ability to have those low cost deposits. And if they're going to lose that advantage, as we go forward here, that's going to be, detrimental to the long-term returns in the industry.
And then, with housing being such a big component of the financial services sector, how are you looking at housing today and over the next 12 months?
Well, I think the trends in housing, the last 4 or 5 years, obviously prices have been up, and we all know that, and we read the papers. If you're paying attention to anything, you know that. But in terms of the financing mechanisms, the housing market is gotten a lot safer for the banks because people are putting more money down, and a lot of homes are being sold for cash, or bought for cash, excuse me. And you're in a situation where there just isn't a lot of risk unless there's a significant decline in the prices. Now, we can all predict that and play games with that, but the housing market is so much better now from a financing position than it was, let's say, going into 2008. And so I don't necessarily worry about the price of housing. You sort of worry about the affordability to the average person. And then, of course, the competition, right? If there's a lot of competition to make those loans, then the pricing on the loans is going to be tough, and that's going to hurt the marginal profitability of the industry. So the housing market is fine. The prices are not great, and that's been, going on for a while. And I'm not sure what the long-term solution is to that besides more supply, but that's going to take time.
So when you look at the commercial real estate space, how are you assessing risk today?
Well, I think that everybody is talking about commercial real estate, particularly office, where the the pandemic has significantly changed the work environment that people are allowed to exercise, and so it's the work from home stuff. And I think that's been a persistent trend that I think is probably not going to go away, which would mean that you're going to have a legitimate decline in the need for commercial office space in the country. And so, having said that, that's what the banks lend against. It's one of their primary, one of the primary buckets they lend into. And if those values have declined because the occupancy has gone down and presumably the rent per square foot has suffered, maybe inflation has increased the cost of operating the building, um, it's going to be an issue. And I think that's something the market's going to work through the next 2 or 3 years. And some banks have pretty significant concentration in that market or in those markets. And so we're going to have a rolling issue here for the next 2 or 3 or 4 years.
All right. So from your seat as a portfolio manager, which subsectors of the financial services industry best represent a good opportunity today?
Well, I think the bigger banks to me are the best position because they have multiple revenue streams. It's not just lending. They've got insurance, they've got trading, they've got investment banking, they've got other types of income because their clients are very diverse, and they have the cover from the feds too in terms of not having to worry about deposit runs. And so I think the big banks make a lot of sense long term, um, which historically has not been the case. Um, but then the other opportunity is really in the smaller banks, the really small banks, where there needs to be significant consolidation, in my view, to stay competitive, given all of the competitive threats from these fintech players, et cetera, et cetera. And the deposit issue. The smaller you get, the more you're sensitive to deposits because you don't have Wall Street to fund you, and so that becomes critical. And if your deposits are going to become more expensive or are easy to leave, then you don't really have a business. So you really want to buy the big ones, and then you buy the small ones because there's going to be consolidation. And everybody in the middle is they got to figure out what they're going to be, and that's going to be a tough one for them to figure out.
Well, Dave, speaking of small cap companies, what type of valuation metrics do you use when you're looking at that space?
Well, historically, it's been, looking at book value and looking at the growth in book value. Um, earnings are important, but if you earn money and then lose it all on a mark to market, so the earnings don't matter. So you have to look at the growth in book, and that's been a historical way to sort of say, look, I'm going to grow book every year, and as long as I keep my valuation to book, the stock should go up every year. Um, and now we're in a where the market has evolved, and now it's the underpinnings are not there. I think that, again, coming back to the deposit side, it used to be we only worried about the assets because the assets are where the bad loans were, and those are the things that need to be written down if there was a problem, and that would obviously impact your capital ratio and your book value. And now we have to worry about both sides of the balance sheet because of this deposit issue and the fact that you have your phone in your pocket and therefore your bank's in your pocket, and so you move things around while you're at, Panera Bread or hanging out at the bar. So now we sort of have to figure out, okay, who has a good deposit base and that can sustain a deposit growth and have a reasonably good cost of funds relative to the yield on assets. So book value has been critical, I think, historically. Now I think there's a sort of a rethink of what to think about, more tilting more toward the deposit franchise, and that's still kind of in flux right now.
Let's pivot and talk about some of the holdings in your funds. Could you tell us the investment case for Coinbase?
You own the big banks, you own the very small banks, but the struggle with the banking industry is that because of a lot of things and its primary regulations, that there's no new products, there's no innovation, there's no creative destruction, and that is creating a situation where they're just boring. There's nothing new, and so it's rinse and repeat. And so I say to people, look, there are times to be the CEO and there are times to be the owner of the equity. And if you look at a traditional bank, the last 10, 15 years, the equities have done nothing from a performance perspective. In terms of the CEOs, they've gotten paid. So they've gotten paid to produce nothing for me as a shareholder. So what I'm doing in these portfolios is trying to add in where I feel like there's proven profitability, but there's also an opportunity to innovate and create new products. And so that one represents that opportunity. And I think that's where that comes into sort of being part of the portfolio.
Yeah, and it's definitely a very innovative company. Tell us a little bit about your thinking behind Charles Schwab in the portfolio.
Well, that one it's a big cap financial, but it doesn't have exposure to loans. It doesn't have the exposure to the sort of the deposit franchise. Yes, it has client assets, but it's more like owning a BlackRock or owning a Vanguard or owning a Fidelity, where you've got an asset manager where you're not necessarily sensitive to the yield curve. You're not sensitive to regulatory control. The stock has historically been expensive, which is, not I'm not a big buyer of expensive financials, but it hits the button of being outside of what the banks are dealing with. So you can have it in the portfolio, and it basically counterweights the exposure that the banks have to all of these other factors that I just mentioned.
All right. And then lastly, what is the thinking behind Visa today?
Well, you think of Visa, you think of MasterCard. These are, the plumbing that runs the system. To me, they are critical companies in the financial services product mix that is used by everybody in the country, and it is a significant provider of services to massive number of merchants here and around the country and around the world. So it is a major plumbing system that if it broke down, um, uh, it would be a problem for the whole world pretty much. But the issue is they have enough profitability. They are investing in the system. They are investing. Here's a case where they're investing ahead of everybody else and staying ahead, and they create a reliable product that people continue to use. The ability to invest and stay invested and stay relevant in a market that needs their services is something that's it has been a long-term holding in the fund, as have MasterCard.
Excellent. Dave, I appreciate you coming back on Viewpoints by Hennessy. Viewers, to learn more about Hennessy Funds, please go to hennessyfunds.com.